Hello ladies and gentlemen. Today's session we are going to start about financial statement analysis. This is a best course. We are going to start about this introduction. Today introduction we are going to start about introduction to financial statement analysis and ratios analysis. Let us start by introduction. This course is concerning with financial ratios and financial statements. When we say about financial statement, is an organized collection of data according to logical and consistent accounting procedure. Its purpose is to express some information on a financial aspect of business firm. Financial, you can say it is a financial report. Here we have 4 types of financial statements that are express financial information. We like to use them income statement or SPOL, profit, or you can also call it profit and loss account, that shows the result achieved during the certain period. It is prepared at the end of accounting year for business enterprise. This income statement, in a simple terms, it shows the financial performance. Another things which is types of financial statement, it is a statement of financial position. Some many writers they like to use balance sheet. This reflecting the assets, liability, and the capital owner's equity of the firm as a particular date. Meaning that this financial position, it shows the position of the firm, how many liabilities we have, how many capital we have. Another thing is the statement of change in financial position, that shows the cash flow and fund flow statements. Here it reports on company's cash flow activities, particularly its operating and investing and financial activities. As you know, statement of change in financial position, it shows when you are preparing the cash flow, it shows the operating cash flow from operating activities and investing activities and financing activities. So another financial statement is a statement of retained earning. Here, appropriate statements express the change of company's equity throughout the reporting period. Here you can say that the statement of retained earning, it shows the appropriate statement express the change of the company's equity. If the company changes, they gonna shows in the reporting. Financial analysis, where we complete about financial statements. Financial analysis of the financial statements or financial report, to communicate information the farmer's profitability, which is a statement of financial performance. Another second is the financial soundness, where it shows the financial position. Financial analysis is the process of identifying the firm financial strengths and the weakness of the firm by properly establishing the relationship between the items of financial statement, more commonly balance sheet and profit and loss account. Here, the financial analysis, it is a process. You are going to identify the financial strengths and the weakness of the firm. The users of financial analysis, we have trade creditors. Another we have is suppliers of long-term debts. Another is the investor, and another one is the management of the firm. Those are the users of financial analysis. When we are going to say about the trade creditors, are interested in the farmer's ability to meet their claims over a very short period of time. The analysis will therefore focus on the farmer's liquidity position. Here, the suppliers of long-term debts are concerning with the farmer's long-term solvency and the survive. Here, the suppliers they want to know if the farm is solvent, is able to pay the amount of money they have brought to them. Investors who have invested their money in the farm, farmers' share, are almost concerning by farmers' earning. They want to know if the farm is getting profit in order to get their dividends if they buy shares. Another, the management of the farm would be interested in every aspect of the financial analysis. It is their overall responsibility to check whether the resources of the farm are used most effectively and efficiently, and that farm financial condition is sound. It is the responsibility of the farm to look at if the farm is using well their resources. We are going to look about the types of financial analysis. We have two types of financial analysis. We have horizontal analysis and vertical analysis. When you are saying about horizontal analysis, in simply you are going to compare the current year and base year in order to say in this year we have performed well, and in the base year we performed badly. So this is what we use, what we are going to look in horizontal analysis. What about in a vertical analysis? We look for 1 year and you compare something like dates. You look for the current ratios and you compare with another firms. That is called benchmarking. So in these types of analysis, financial statements for a number of years are reviewed and analyzed. The current year figures are compared with the standard or base year. The statement usually contains the figure for 2 or more years, and the change for 2 years are shown regarding each items from the base year, usually in the form of percentage. We are going to compare the 2 years, and you say in this year there is an increase in 2%. That is an example. Such analysis gives the management a considerable insight into the level and the areas of strengths and the weakness. Here it shows the for management we have weakness or strengths. Since these types of analysis is based on data from year to year, rather than 1 year, date or period of time as a whole, it is also known as dynamic analysis, meaning that, as I have said, we look for 2 years and we compare. In this year we did this, and we have a weakness or strength. Another, as I have said, is a vertical analysis. In these types of analysis, a study is made on the quantitative relationship of the items in the same financial statements on particular dates. Here we look for particular dates, not comparing 2 years. That means the ratios of different items of cost for particular period may be calculated with the sales of the same period. Here we have the same period. Such analysis is useful in comparing the performance of several companies in the same groups or division or department in the same company. It is also called statistical analysis, as it is frequently used for referring to ratios developed on one date. Here you use it for several companies by comparing division or departments. You are looking for Department of Finance, Department of Manufacturing, in order to compare. Ratios analysis, common tools of financial statement analysis. Here they are saying that ratio analysis is a common tools of the financial statement analysis. When you say ratio, you are going to say that the proportional. It is like to be used in mathematics. Refer to indicate the proportion of two mathematical expression like 2/3, 2 divided by 3. This is express the relationship between two or more variable. A financial ratio is defined as a relationship between two accounting figures reported in the financial statement. It's expressed mathematically. Financial ratio is used as a benchmark for evaluating the financial position and the financial performance of the firm. Meaning here we use the two types of financial statement, where we use profit and loss account and the balance sheet in a simple term, and you compare, and that means benchmarking how the firms you are going to evaluate how the firm, their weakness in the financial performance and financial position. The absolute accounting figures reported in financial statements do not provide a meaningful understanding of performance and financial position unless the analysis is done. If you don't know, you do not doing analysis, you cannot get if the firm is doing well. In order to understanding well how the financial performance of the firm and the financial position of firm, you are going to do analysis. Let us go about benchmark for analysis. For ratio analysis, meaning stand for comparison. Meaning here, when you are using benchmark for ratio analysis, you are going to make a comparison. The ratio analysis involves comparison for useful interpretation of financial statements. Here, a single ratio in itself do not indicate favorable or unfavorable condition unless comparison with the same standard is made. We mean that in here, meaning that there is a standard you prepared before, and also you meaning that there is a base year, and also there is a current year. You are going to compare that years. In benchmarking, we including the time series analysis, where evaluating the firm's financial performance and financial position by comparing the present ratios with the past ratio. Here you are going to meet the past ratios. Here there is a past ratio, there is a present ratio. You are going to compare in order to see if we did well. Financial ratios over a period of time are compared. It gives an indication of direction change and they reflect whether the firm financial performance has improved or deteriorated or remained constant, meaning that you are going to see these three kinds. You are going to look if financial performance has improved or deteriorated or remained constant. In that period you have said, or you are going to evaluate. The analysis, the analyst should not only ascertain the change but also the reason for change in a given ratio. When you are going about benchmarking, we are still about benchmarking what include. The first we look about the time series. The next is a cross-section analysis. Here you are going to make a cross-section that is comparing the firm's financial ratios with the ratios of the sum selected firm in the same industry at the same point in time. You are going to select some industry, and also you continue to make a benchmarking. It is also known as interfirm analysis. It is of the paramount importance to compare the farmer's financial ratios with the ratio of the few carefully selected competitors. It therefore indicates the relative financial position and performance of the firm. When another thing for benchmarking that includes is the industry analysis. For the first, we'll look about time sales. For the second, we'll look about the cross section. For third, we are going to look about industrial analysis. That is to compare the firm financial ratios with average ratio of industry of the firm, its member. It's help the ascertain financial standing and the capability of the firm, vice versa other farmers in industry. Another rest is a pro forma analysis. For pro forma analysis, here they mean that is to compare the firm financial in this case, future ratios are used as benchmark for comparison. Future ratios are developed from projected or pro forma financial statement. This is a very useful since when the future ratios indicate weak financial position. Another is this is a very useful since one of the future ratios indicate weak financial position. Corrective action should be made. It should be indicated. Let us go about the types of financial ratios. When we go about the financial ratios types, we look about liquidity ratios, which include current ratio, acidic test ratio, cash ratios, and then another thing is net working capital ratio. For leverage or gearing ratios, we look about the debt ratios, debt equity ratios. For activity or turnover ratios, meaning that here we are going to look about how the returns I get for using an asset. For gearing, as I found, we look about in how to depend about the borrowing. For liquidity, we look about how we can fulfill obligation of short term. For profitability ratios, we look about margin ratios, sales margin ratios. Another last is valuation ratios, where we look about the equity related ratios. When you are going about the liquidity ratios, here it measures the farmer's ability to meet the current obligation. As I have said, we are look about for short-term obligation and current liability. By establishing relationship between cash and other current assets and other obligations for current liability. The most common liquidity ratio are current ratio and quick ratio or acidic ratio. As I have said, in liquidity ratios, we have current ratio, we have quick ratio or acidic test ratio. We have other liquidity ratios, which including cash ratios and net working capital ratio. Okay, so we can stop here for today. In another session, we should calculate the current ratio and the liquidity ratios and the net working capital ratios, meaning that we will look about all liquidity ratios in this example of Kazi Street Manufacturing Company. Thank you for today. My God bless you. Remember to subscribe. My name is Evariste. My God bless you.